Okay, welcome everyone. Here's another session of Brick by Brick, hosted by myself, Robert Blake, and I have Matt Barnes here from Centurion REIT. Before we get going, I just want to read out a quick disclaimer that this webinar is for educational purposes only. The contents intended to provide and should not be relied on for tax, legal, or accounting advice. Nothing in this presentation should be recommended or construed to solicit an offer to buy this particular security. Parvis is basically a real estate market and exempt market dealer. We bring institutional quality real estate such as Centurion to you. Please reach out to myself or your dealing representative to see if this is a suitable investment for you. So I'm going to turn this over to our guest today, Matt Barnes. He's been at Centurion for a long time, has great insight, and a real pleasure to have him and take this valuable time out for us in the audience here. Thank you, Matt.
Oh, very welcome, Robert. Great to see you again. And actually it'll be 11 years this June 15th that I'll be at Centurion. So it's been, I'll say, a great place to be. And we've seen some good growth over the years and exciting for what the future holds. But I'll jump in and share some slides with you guys. Okay, perfect. I'll real quick background here on the firm itself. Centurion, the fund we have today, the Centurion Apartment REIT, was launched in August of 2009 with about 55 million in assets. It was launched by our president and founder, Greg Romand. He had a LP for friends and family for a few years before that with a different mandate, but the 55 million rolled over into the REIT we have today. And you see we've had some very successful years, some very strong growth, and the firm now has over 410 employees, for getting close to 8 billion in assets under management. What I do like to highlight here is we've had some great growth over the years, absolutely. But I'll say it's been growth that's been done the right way. There's a real discipline to what we do, a real discipline on protecting investors' capital first and foremost, looking to provide some attractive income and then some appreciation on top of that. So I'd like to say that Centurion's been around for quite a while, and we made the decision. Obviously, we want to be around for far longer by making sure we protect investors going forward. So it's been a great 22 years, and I would expect another great 22 years going forward.
Matt, just for information's sake, is 7.8 billion, does that make Centurion the largest private REIT?
It is the largest private apartment REIT in Canada. Yes.
That's significant.
It's been absolutely. I think it will be one of the two or top three REITs, including public. So it's definitely up there in the Canadian space. Now I just want to jump down here, and I'll highlight a few of the pieces of information here. One, this is as close as you can get to direct real estate ownership with none of the headaches. So you're getting a truly extremely well diversified portfolio across Canada, which is in and of itself something very hard to duplicate as an individual investor. But you're getting that real hard asset exposure. So you're not having to worry about what happens in the public markets. I know now, especially, things can be a little bit interesting. We'll put it that way. But this is a real benefit of being in the private, actually owning. Think about it, actually owning the asset itself. So the real estate, the fund itself, has been around again for over almost 15 years. And it's available in all type of accounts in Canada: RIFs, LIFs, TFSA, whatever it is. And also, it doesn't show it here, but besides 3 countries in the world, any investor can actually buy into it. So if someone is abroad, ex-US, Iran, and North Korea, they can buy into the fund as well, get exposure to Canadian real estate. And I always like to look at it is Canadian real estate is nice and boring. I think a lot of people appreciate nice and boring, having that little sleeve in your portfolio. But I also say nice and boring, but also with attractive returns since inception. And you'll see this since inception, returns have been about 12.3% annualized over the years. And one thing I will definitely highlight here, if you look on the, I'll say the left-hand side, is majority independent board of trustees, which I think is very important. We really built Centurion. The REIT has been built out to have all the best practices you would want to see if you're an investor. And by that, I mean majority independent board of trustees, as you can see there. We get an audit by KPMG every year. We also have an auditor review, or we have a real estate valuations team from our auditor value our monthly audits, so value our monthly appraisals of our buildings. And then if you go to our website, which I think is, if you, as an investor, you'd want to see this, you can go to our website and see all of our offering memorandums, our financial statements, again, the bios of our executive team, the bios of our board of trustees. So obviously we have transparency is by far second to none. So I do recommend that for any investor, and that is what you would want to see. So again, we're as open and transparent as any well-run publicly traded company out there. And this just gives you a nice little map of where we're located here in Canada. And we have 4 properties in the US, but 158 in Canada. So we'll focus on those. We like Canada, great opportunity set here. And obviously we have a very, very strong position in this marketplace. But I will break down the portfolio this way. In Ontario and BC, we'll be in the primary and secondary markets. So Ontario, not downtown Toronto, and I'll stress that, and the same thing in BC, not downtown, not in Vancouver. Very expensive place. That's not our market. Our focus is middle income type of properties. So we're not in the downtown condo market here in Toronto, but we are removed. We're outside. We're out in Scarborough. Then we're out in Oshawa. We're out in East York. Then going out, out into Mississauga. So we're where people, I would say, are looking to live, looking to move to. High quality, well-run, well-maintained buildings, but obviously a different price point than what you see in the downtown core. And I live downtown. I'm in condo land on King West. I like it, but the price points here are excessive, I would say. So we want to be in that more middle income type of buildings, a little removed, obviously. Same thing in BC. I mean, obviously the price points in like Vancouver proper, beautiful city, but extremely expensive. So we're up, as you can see here, in Kelowna, in the suburb of Surrey, on the island. So we want to make sure that we're where people want to live, have access to the city, but it's far more affordable. And then the rest of the country, just the primary cities alone. So if you look at Alberta, obviously just Edmonton, Calgary, Saskatchewan, Regina, Manitoba, just in Winnipeg, even Quebec, the largest rental market in the country, just mostly Montreal, and a few buildings up in Quebec City. So just the primary cities in Quebec, and then two buildings in the suburb of Dartmouth, which is a suburb of Halifax. So that's our apartment portfolio, which is about 82%. And then we have student residences that account for 11% of the portfolio. And those, and I'll stress this, we get this question, we're not being affected by any slowdown on international students coming to Canada. The focus for Centurion has always been with the student housing, 4-year universities, 10,000 plus students. And we're looking at areas, well, I would say highly regarded universities as well. So if you look where we are in Montreal, that orange circle in Quebec, we're downtown Montreal, so very close to Concordia, very close to McGill, very close to UQAM. We have student residences here in Ontario, in London, so all Western University students, very close to campus there. Same thing in Waterloo, very close to Laurier, very close to Waterloo, so great spot there. Calgary, University of Calgary is where we have, or very close to University of Calgary, rather. And then in BC, we're actually on the campus for the university there. So we are in an excellent spot. And in real estate, location matters, especially with student housing. And then we have the one property here in downtown Toronto. It's on Ryerson, or now Metropolitan University campus. So we're great location across the board. Student housing is 100% occupied, doing extremely well for us. And really the rest of the portfolio overall is combined is 95% occupied. And then if you look at it, our stabilized portfolio is about 98% occupied as well. So that kind of X's out the more recent acquisitions, and it's really a good barometer of how we expect the portfolio to be managed. We should be having those high occupancy rates. This just gives you a bit more detail on where we're located. And you will see just a little sleeve U.S. apartments, again, just 4 down there, and not a focus for us. Then we have the medical offices. Again, that was a real value opportunity, but again, a very small part of the portfolio. So if you look at this fund, think about it, it is going to be apartment buildings, predominantly apartments, with some student housing, and then a little sleeve, as you can see there, about 4.3% of lending. So that's lending to developers. We don't build. Centurion is not a construction company. We have nothing. We're not doing that, but we know good developers. And the great thing about this little lending sleeve is, one, it's not cheap. We're not providing cheap money, but there's good, well-run developers can build out properties that we would like to acquire. So we help provide the financing for that, and then we have the right of refusal. Once the project, right of first refusal, once the project's been completed. So it does help us get more properties into the portfolio. And I'll say especially now, where we're seeing developers take a big step back. So if buildings aren't underway, we're seeing developers really just want to assess the landscape. Obviously, politically, there's some issues in the world, tariffs being a big one. But we're just going to, a lot of developers naturally just want to wait and see before they make big, large dollar commitments on construction projects. So for us, we're still going to see some opportunities to acquire, and you'll see that a bit later in the presentation. And sorry, just touch on here again, the focus for us, as you can see the breakdown in Ontario, 35%, Quebec 30%, BC 19.5%. Then we have that little sleeve of almost 10% in Alberta. So we're in the larger, again, I stress this, we're in the larger population centers in and around the cities. And we did that obviously very purposeful, be where people want to live, where there's more economic opportunity, more diverse economies, so you don't get stuck in being, one stoplight town, or sorry, a one factory town, if you will. So, and especially these days, it's good to have that diversity and opportunity. And this is to show you the returns of the fund since inception. You can see here our target return is 7 to 12. Just a few notes. 2009 was an abbreviated year, and then you can see since then we've done really quite well. We've had some very, very strong years, some above our target return, some obviously on the lower end, and really 1 year, 2023, when we had just dipped below our target range of 7 to 12%. But we look at the REIT itself. It's done exceptionally well since inception, 12.36%. And the fund, we look at it is we're going to start to, we'll look to see, I would say, obviously, as I mentioned, there's going to be a slowdown in development just naturally, a lot of uncertainty out there in the world, but we're still seeing strong population growth come to Canada. So, and we build slow. I'll add that in there. Again, so oversight, government wants to make sure things are done properly. Not a bad thing at all, but it can slow things down. So the permitting process can be slow. So we're going to see, I would say, less development, obviously, going forward, but still going to see strong population growth, because really Canada does rely on immigration to increase the population here in Canada. So that'll continue, and I think we're going to start seeing a bit of a meaningful drop off in what's available, and that'll just really tighten the market and within the kind of the next 12 to 18 months. So again, that naturally that demand increasing and supply not at anywhere near the same level will push prices higher. And this chart is something our marketing team put together a bit earlier this year, and I got to say it's the chart I by far like the most.
Yeah.
And I say that just because I talk about the REIT, this Centurion Apartment REIT being a very nice, very boring fund. And you can see here, European, starting with the European debt, sovereign debt crisis, the U.S. had its own debt crisis, and then everything else, Chinese stock market crash, trade wars, COVID. Like the REIT itself, we're in Canada, there's a real benefit to that. But you can see it's steady, nice and boring. But at the same time, providing a very attractive returns for investors. Very attractive returns, plus very attractive, I would say, tax efficient income as well. But it's one of those things you invest in, and then you don't have to worry about it. because there's a real benefit to being here in Canada. I know there's this, excitement in the world these days, but we are in one of the lowest risk jurisdictions you could possibly want to invest in. And getting into multi-residential with Centurion, getting into investing in one of our properties, exceptionally well diversified, as you'll see, it really makes a big difference. So this is something that, the world can go a little uncertain, to be polite about it, but Centurion Apartment REIT just keeps doing what it's doing, and it's done that extremely well. I love this chart, actually. If I had one chart to share with everyone, that would be it. And this is here just a comparison of the REIT versus kind of major market indices represented by the iShares ETFs. So you can see here the Centurion Apartment REIT is the blue circle, upper left-hand corner. So volatility less than the iShares Canadian Government Bond ETF, with performance just shy of what you would get from the iShares S&P 500 ETF. So as an investor, that's exactly what you would like to see. Low volatility with attractive returns. And again, just fundamentally, that's the Canadian apartment market. And I think one, especially run by the team at Centurion, it really does protect investors, but while adding or ensuring some attractive returns. So this is, again, another very nice chart that I think any investor would like to see as well. And here is, we'll start with the gentleman on the top there, Greg Romand. He's the founder of Centurion, well, now executive chair and founder. But I will highlight his background a bit. He was a former derivatives trader, had a tremendous career, worked in Toronto, New York, London, Hong Kong, and then Singapore, where he was senior vice president and partner emerging markets derivatives for AIG, well before AIG had issues. And I highlight that because as a derivatives trader, his job really is help obviously find opportunity, but very much is mitigate risk, trying to determine what the risk is out there and minimize that as much as you possibly can. Very successful career, then focused on building his real estate holdings out here in Canada in the early 2000s, then incorporated Centurion in 2003, then launched the LP precursor fund, which had a different mandate in 2006, and then the REIT was launched in August of 2009. So tremendous experience both in capital markets and in real estate. And but I do like to highlight the mindset that Greg has brought to Centurion, but also that you'll see in the executive team, you'll see in the rest of the management team as well. And that is to protect investors' capital first and foremost, generate attractive tax-efficient income, and then drive some value appreciation, drive the capital appreciation on top of that. So you can see here we actually just brought on John McKinley end of March. So he's got a very, very strong resume behind him, CEO of LaSalle Canada, and then also previously at Bentall and GE Real Estate. So again, tremendous experience in the in the real estate space. Paul Chin, CIO, same thing, worked for Otera Capital, the real estate lending arm of the CAS in Quebec. So I think that is Canada's largest pension fund. So tremendous experience there. Then we have Ryan Bazell, who has worked with Centurion for quite a long time, and he's responsible to lead the real estate lending team. The one I mentioned, that's right now about 4.3% of the portfolio. Really generate opportunities to lend, generate attractive income, but also allow us to make acquisitions as well. So very strong board of, I'll say, executive team, but then very strong, analyst team, very strong operations team, exceptionally strong on the operations side of the business, the day-to-day running of the buildings. They do an exceptional job there. So I always look at this. This was founded by Greg Romand, but this is a company that, Greg will be working at Centurion. He'll be here for another 20, 25 years. He's not someone to retire early, that's for sure, but a company that's been built to last well past his tenure at Centurion. And just a couple of things, we have a lot of slides on the fundamentals. I didn't include all of them, but just as a highlight, Canada still sees strong population growth. As a country, we're now over 41 million. And at the same time, we have 41 million people in Canada, seeing close to 400,000 people coming to the country. On the immigration side, never mind, we're still, accepting international students, temporary workers. So we as a country, don't build fast enough. I think and I'll say this from someone who lives in downtown Toronto, where I see the construction very slow. And I'll just add to that, if you're familiar with the crosstown subway in the Toronto area, we're not fast there. So, great country. I mean, we're building, but we're building slow, and it's just I think reflection of, one, you obviously want to do your due diligence before you build, get government approvals, but things are slow. So we're not, and I say this, we're not going to get ahead of the undersupply in housing. It's hard to see that within the next 10 years. I don't know what would change to really allow us to get ahead of that, but we're looking to do so. We're looking to actually add more housing, but it's tough to see. It's tough to see. And this is just another slide I like quite a bit. Just shows you, early since 1956, how much we've been able to build in Canada. So those on the chart on the right there, obviously, dark blue bar on the bar chart is a single detached homes, and the light blue on top of that, semi-detached row and apartment starts. So we've been pretty consistent. There's been some surges in immigration over the years, a bit of a surge in construction, but really, we've never come close, I would say, to really breaking 300,000. It'd be hard to see us break 300,000 in housing starts and actually housing completions, and then do that on a consistent basis. And we're looking at, realistically, to build out the housing we need, we're looking at a couple of trillion at least, probably more than that, about $3 trillion in financing, say, over the next 10 years to get there. And a third of that would go into, say, the rental market. And Centurion is the largest REIT in the private space, one of the largest in the country. And you can see our AUM is 7.8 billion. So when we start talking, hundreds of billions of dollars, it's just not there. But I like this chart. It very simply highlights the strong population growth we've seen, but the housing starts. And quite frankly, I mean, never mind the financial side of it, where actually you need money to build these things, is that we don't have the skilled labor. Like the skilled labor, it's not an easy job, and we've all seen this, people working out there in the middle of the winter or the heat of the summer. But we just don't, not many people are going into that. That is in an industry or a sector in the industry that's just not getting enough people, not enough labor with the right skill set. So that's not going to make things any easier whatsoever. Tariffs, we've get questions about that. Here you see could lead to lower interest rates, which could have a beneficial impact, obviously, on mortgages. Then the potential trade war, retaliatory tariffs. Could be tough to see where this leads to. Hopefully, and I think this is from a little bit earlier in the year, but I look at it, it'd be tough to win a trade war with the U.S., just obviously their size and the U.S. being the U.S. But I would say, look, it is just creating some uncertainty, but the U.S. is pushing to kind of maintain its economic dominance. So I think Canada, being in North America, should ultimately be in a beneficial situation once things kind of shake themselves out. But we'll see. We'll obviously have to see where things go. But really to the third bullet point there is, with this uncertainty, and kind of touched on this a bit earlier, is developers, obviously, it's hard for people, any business really, to want to go out there and commit tens of millions, hundreds of millions of dollars to new projects when there is this real uncertainty out there. So the sooner this, if you will, the trade war can be, I guess, resolved, then at least create certainty on what the policies are going to be. And then we should see a bit more development come back online. But right now, from what we're seeing and from the developers we know, everyone's pencils down. Unless there are projects underway, no one's looking to start anything new. Too much uncertainty out there. So it's going to be interesting. I think, and we're seeing this actually in the condo world. And I don't know if that was really too much related to what we see with the tariffs, but condos just really, the pre-sales, we're seeing them at multi-decade lows in the GTA, and that has been a big supplier of housing. So we're going to see that drop off, probably 18 months, 2 years, maybe as those projects go through, the pre-sales just are not there to finance anything else to come online. It's really going to be, I think, quite dramatic in about 18 months, 2 years. And I'm sure you've seen this in the news as well, where the buyers aren't there either. So we're seeing, people did the pre-sales, try and sell out of those positions, sell out of those units, and it's very extremely tough to do so. Excuse me. So we're not seeing the capital flow into that, and to the condo sector right now at all, and that is going to lead to a real shortfall on housing, because condos do provide, obviously, for people buying, provide housing, but also if a lot of them are rented out, provide rental housing in the major cities. So that's going to be, I think, something very important to watch, and I would expect to see a real decline on that, and that will just put more pressure, more demand on the rental housing market as well. And this is just a nice little chart here that just shows the REIT itself. This is very much related to what the REIT and the rent to market gap is simply if every tenant in our portfolio signed a brand new lease today. So right now, it would increase the rental income by about $38 million. And depending on, we'll say roughly discount that at kind of just over 4%, you're going to be getting about $800 million in future value for the portfolio. But what this also highlights is obviously there's the upside potential for the REIT, and some of that rent to market gap is realized every quarter as tenants move out, so we are able to raise rents to market when that happens, but also shows you there's a bit of a cushion in the portfolio as well. So slightly a little bit below, as you can see here, below market. So it just gives us a cushion, even though tenants do leave, life still happens, people do have to move around, but doesn't necessarily mean we may not necessarily get an 8.14% rental increase, but we will still get an increase because we do have some tenants below market on that turnover. So I know with the uncertainty out there, this is a very nice cushion, which still allows us to realize some higher rents in this marketplace as well. So and when things obviously, I'll say, normalize a little bit, but also when we get out a year, like 18 months to 2 years, when we start seeing, I'll say, more dramatic shortfalls in housing, then the rent to market gap could really start to push considerably higher. And this will just give you touched on this somewhat already, but just an idea of where the REIT is focusing on, what we're looking to do. And again, in Ontario, in BC, primary and secondary cities. So, Toronto area, not downtown, obviously same thing in BC, not in the high cost, Vancouver proper, but out in Kelowna, on the island, out in Surrey and that, same thing into the Toronto area. Out in Scarborough and further east, out in Etobicoke, Mississauga, and go further west from there. So we want to be where it's going to be relatively affordable for far more people, larger potential tenant pool, large potential upside from that as well. And it will be multifamily, really the focus of the REIT. I know we have a few other little sectors in there. It'll be multifamily and will be new builds. We were able to, over the years, bring in some obviously older buildings, make upgrades on those. They're great assets to have, but obviously no one's building any new old buildings. So all the assets we'll be acquiring, I would say, are going to be these new builds. And that's really reflection, one, of obviously the marketplace, but what the demand is. And we're seeing that we are seeing some of the largest or best qualified tenants we've ever seen. So people just, normally $100,000, you think you could get a nice place to live, go out there and buy something. Not the case. So if you're looking in the GTA, you're forced into a rental market for a few years at least. And you have a good income stream. Like, we're seeing highest income, great credit scores of a lot of new tenants coming into our buildings. Because that kind of, like, what would you do? And now especially, what would you do? There's a lot of uncertainty in the world. You want to go out there and make one of the largest acquisitions or one of the largest purchases that you're going to make in your life? Maybe not. And if you're younger, sometimes we're seeing some people just, enjoy the buildings. They're in good locations, but you want to be, house poor for the next 20 years. So we're seeing a very different mix. More, very, again, highly qualified, best credit scores, good incomes coming into our building. So it's definitely a different mix. We're also, I'll say at the same time seeing, and I see this actually in my building, we're seeing more families. So you're seeing more developments with kind of 2 and 3 bedrooms. Not a lot, especially not a lot of 3 bedrooms. So you're seeing more 2 bedrooms in coming to the portfolio, just because people are growing up in high rises and growing up in high rise rentals as well. So it's a bit of a different approach to what we're seeing in the housing market. Things are changing in Canada, and it's definitely not a bad thing to have to live in an apartment building. I'm very happy living in my almost just under 600 square foot condo. It's a different lifestyle when you're living, say, downtown. More things are walkable, that type of situation. But the marketplace is definitely changing. It's harder, and we saw this. I don't just add this. We saw this during kind of COVID when things are shut down. Then people left, moved out of the city. They had to go further afield. They wanted to live somewhere, the fresh air, obviously, which is always nice for everyone. But then they realized living way well outside of the city isn't for everyone. I'll put it that way. So then we saw people moving back into the city. The city can be very attractive for a lot of people. Again, I love it. I live here. But we're seeing a lot of people obviously want to take advantage of what the city can provide. And that means they're going to be living in high rises quite a bit, condos, and obviously a lot of rentals as well. I'll just touch on one more piece on this slide. It is the maintenance, or I will say the operations side of the business. That is something we do, I'll say, we do exceptionally well on how we run the buildings, how we maintain the buildings. We always want to make sure that buildings are attractive places to live, clean, safe, well kept. But we also spend, if you look at it, from quarter to quarter, it could be $15 million, could be $25 million on capital investments in the properties. You always want to make sure, again, that these are attractive places to live. You can make upgrades, you can make repairs, but you want to make sure everything's done properly, timely. And there's also obviously new technology coming in. It could be triple pane windows. It could be, toilet sensors to make sure you understand if the toilets are running or not, or whatever it is. There's technology also out there that we implement in our buildings to make sure that they're run as efficient as possible. But also definitely make sure that they're attractive buildings, as you can see, but also at the same time safe, clean, well kept places that people would actually want to live in. And this actually here is just a great example of some of the initiatives we have in making the buildings more affordable, more efficient. You can see LED lighting, as you can see there, cooling optimization, installation of pumps and makeup air units, gas consumption, the units sub-metering as well. So we just want to make sure people are paying, and at the same time the water reduction. So we do take that side of the business very seriously. We want to make sure that the buildings are as efficient as possible. Make sure they're a good investment. But at the same time, don't get me wrong, we want to make sure that the buildings are very attractive places to live as well. And then as I would say, that's very much highlighted by the high occupancy rates that we have in the portfolio. Again, 95% overall, 98% in our stabilized buildings. So that just really highlights these are attractive buildings. They're well-kept buildings, and tenants like being there. And this will just show you some of the more recent acquisitions that we've made. And again, nice buildings, nice properties. But again, a lot of this is out in Western Canada, really Kelowna, as you can see on the top, Calgary, a couple of buildings in Calgary to kind of on the top row there. Then you can see a few more in Kelowna, Victoria, BC, Winnipeg, Dartmouth, Nova Scotia. So we are seeing opportunities across Canada. And we do get the question, are you still looking for opportunities in the GTA? Absolutely. But I will say the one thing that's obviously very important, one thing that has really protected investors over the years has been our approach to acquisitions. We're not chasing deals. We're not getting in bidding wars, which I think is very important. Really, your return on an investment comes down to what you pay for that. So we're happy if we don't get our price. If we don't, the price is something we don't think makes sense, we're not going to pay. we're not going to buy it at that price. So you can see we have other acquisitions to make, and we're happy to sit on the sidelines and do the right thing with investors' capital. So that has really rewarded investors over the years. I mean, you pay too much for an asset, that can really come back and bite you. You know what? But we've been very exceptionally disciplined on making good acquisitions, areas we like, in buildings. They're well situated, well put together, but really service the local market very well. And that's gone extremely well for us. And you will see here, so some of these buildings, 50% ownership, 67% ownership. That is sometimes the developers do retain an ownership stake in the properties. Usually they will get bought out. We'll likely buy them out in, depending on the situation, 1 to 3 years, we'll say. Right now, especially, I think developers, they're building, and they do like to retain that, just because now it's tough to take that money and put it to work somewhere else. So they want to, if they can just effectively retain that ownership stake, while Centurion obviously runs the buildings, and we do run the buildings, and they can wait for better opportunities, and down the road, very likely Centurion will buy them out of their ownership stake, and allow them at that point to go out and put up more, build more properties. But for them right now, it's a great opportunity just to kind of, if you will, sit on your bank, your capital in the property they just built, and then wait for the situation to really clear, obviously. And these are just some other projects that we do have underway, and as you see, the Trinity in Calgary, that was on the last slide. Some of those buildings have been completed, and we have just a couple more to go. Excuse me. And the building up in Ottawa is, I know there's a couple of bigger buildings going up in the downtown core of Ottawa, and from the people I've spoken with, it's being extremely well received. People want to live down there, so it's nice to have that. But again, these are, I never say look at them as they're very nice higher middle income type of properties, again with, as you can see, more amenities. And then Trinity Hill in Calgary, I mean, that's 10-15 minute drive from the downtown area. Kelowna, I've been there a few times, and the one thing I do hear from the advisors we've met with over the years is too many people are moving there. It's a very nice city, great climate, so I can understand why. But we do have some nice, very attractive properties coming online. And this will just right here will just show you an example of some of the student housing that we have. And I will say this has been a fantastic, I'll say niche, about 11% of the portfolio for us. It's been something that's been sorely underdeveloped here in Canada, but these properties all very, I'll say very nice, far nicer than the type of student housing I lived at, but great locations, great amenities, very attractive too for the international students. Just some people think all the international students aren't coming to Canada anymore. They are. They're going to the 4-year universities. There's no issues with that. So these are in the very nice buildings and great locations. And I'll say this, they're not cheap. I had the chance to visit the Hub building in Calgary last summer, and 100% occupied, great looking units, great amenities, very close to campus, and also somewhat close to NAIT, which is the kind of technical institute nearby, but really focused on the University of Calgary, and great demand. So it's just like student housing is again another area that's been sorely underdeveloped here in Canada. This is just a few awards we won last year for 2024. It was Greg Roman, our president. But I'll really summarize it with this slide, and I'll say first and foremost, the benefit for investors is, as you can see there, it generates a monthly income, focuses on preserving your capital, but diversifying, obviously a great way to diversify your portfolio. But this is something that's exceptionally difficult to duplicate, to go out there and build out your own personal real estate. Definitely some people can do it, and they've done it very successfully. But it is something that is tough to do. And especially now with the uncertainty in the marketplace, this is something that actually gets you that real estate exposure with none of the headaches. You're not trying to figure out what the rent should be, trying to figure out what how much you have to borrow to make a project or an investment work. This is as close as you can get to direct real ownership or real estate ownership with none of the headaches. So I think that's the real benefit for investors. Get outside that real investment that gets you outside of the public markets. And as we've seen, like great publicly traded REITs, but they, obviously they're subject to the whims of the public market. So this is a nice, very nice way. It's in Canada, larger cities, great way to get that diversification into your portfolio. And at the same time, and I always say this, look, you can go to our website and I say you can look at the OM, the offering memorandum. You can look at the financial statements. Every financial, document we have is there. You can look at the majority independent board of trustees and their bios. You can look at the bios of our executive team. We are as transparent as anyone, by far as transparent as anyone. So this, I think it's a fund that is as open as it can be, really does provide you with a very attractive return, and in an asset class that's very hard to duplicate right now as well. Just really touch on one thing that I didn't mention is I did mention obviously the returns since inception, very attractive, and we do provide a very tax efficient income. So right now the distribution is about 4% cash, and last year for 2024 it was 84% return of capital. The year before that it was 84%. So we're expecting the return capital component to remain relatively high. Maybe not 84%, and that's always hard to foresee what that will be, but an attractive tax-efficient income stream for investors as well. So we're excited about what the futures hold, and you saw we had saw a few years that were a little bit on the low end of the returns, but we're looking at a situation where we're going to be underbuilt. We're going to start to obviously see less building going on, more of a shortfall. And I think real demand for what Canada has to offer, which is some very attractive, very nice housing in and around large population centers in Canada. Which again, I think is very important for that, like where we're located. Just because people come into Canada, come for opportunities, come for a job, better life, and it's easier to be easier done. If you're living in the suburbs of Toronto or Vancouver or Montreal or out in Alberta and in Edmonton proper and Calgary, where there's just going to be more opportunities. So we're excited about the future. It's we're living through some interesting times, but we're very excited about what the future is going to hold. With that, I'll wrap it up there and I guess stop sharing my my screen. But if anyone has any questions.
Yeah, I do.
Please.
Awesome, Matt. Centurion is the gold standard, I think would probably be the appropriate term for your product offering in the private capital markets. Long track record that's pointed in that direction. That's not just anecdotal. And again, Greg and the awards and your team with all the awards within the private capital markets, further evidences that there's a lot of competition out there vying for that, but you guys seem to pull it off not just once, but time and time again, and testament to your organization. And I believe even in the HR side, you guys are hitting it out of the park too, right? Your
Oh
staff
yeah.
are giving the same feedback, right? It's not,
Yeah.
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 In some other experience I've seen, the experiences as an advisor with dealing with Centurion. Again, we have a lot of choice to advise clients to go into, but there's some standout things that are worth mentioning that I look at. One is by far is the board of directors, the independent board of directors. The more you spend time, the more you learn about private equity, that becomes more and more important. So I can't stress that enough for investors when you're looking at these different offerings on, say, Parvis's shelf. There's 50 of them. Start looking at the bios of not only the independent directors, but the senior managers and executive team. Where they trained, where are they coming from, and where are they going. You're just not going to get anything better in the marketplace. And again, this is my opinion. Um, and then another thing that you may not see investors as you see this is they have about 4 or 5% lending sleeve, which again, I think, Matt, that's unique in this space. Like no one else does that of your peers, I believe.
I don't think so. And it's, yeah, a very nice way for us to get buildings into the portfolio that obviously we know. We know the developers, we know the project. So it's been a great way to get more acquisitions for sure.
Which is exceptional. I mean, the way I view it in my terms is like you guys are manufacturing your own buildings in a sense, right? You partner up with leading developers, lend them the money, take you know, which avert some of the risk and budgets and things whatnot to build this, and then at the end, if you with your first right of refusal, you can buy it or not. So I mean, that's a very creative way that I haven't seen anyone else attempt to do that, which is ensures that you can keep growing the AUM of the REIT, which is now I saw 7.4 billion. Every time I blink or see an update from you guys, I'm out by about $250 million or something like this. It's
Yeah.
incredible. Then on the automation side, maybe Matt, if you could just maybe share some of the things that you do when a unit is been notified that one's going to become vacant and that process and what Centurion's done, it's to automate it. I mean, uh, it's a little bit in the weeds, minutia, but I think it's interesting for investors to understand that a little bit.
It's, I mean, yeah, anytime someone leaves, obviously there's going to be a very thorough cleaning, and usually for everything from just painting, repainting the walls to, making upgrades in the building, in the unit. And that is, I mean, it's could be everything from new light bulbs, so, third generation LEDs that are more efficient, replacing the appliances, putting sensors on the toilet to make sure it's not running. Um, it's we always want to look at what technology is out there that can actually make this more efficient. One, just obviously make it still very much a pleasant place to live, place that tenants would want to be in, um, but find ways to reduce what we're the electricity, the water that's being used at the same time. So I mean, and I'll say just we get this question: what about solar? I mean, that's great opportunity, but the roofs, like it really comes down to the roof space isn't there. So you're not going to anywhere near enough panels. It'll be a negligible, you know, increase in actual electricity that would be for the windows. So if they're at one point, maybe they can increase the intensity of those. And I mean, you've read about this over the years, like potentially paint would be effectively be solar panels. So if you could paint a building, that'd be interesting. That could be something that would be a real game changer. But we're not there yet. So you can't put all these solar panels on a roof. You're not going to get anywhere near enough. And then the issue becomes when you have to replace the roof, when you have to do repairs on the roof. Like it's tough to make that work right now, especially in Canada. Just rain, snow, everything that comes with living in a four seasons country. But we're always looking at ways to make the buildings more efficient and just obviously attractive places to live as well.
Yeah, no doubt. So I did notice there was some change at the senior executive level. Maybe just a comment there. What investors may look for more of the same, maybe perhaps some add-ins. I'll leave
It
that up to you.
it's great to get those you know sorry, Paul Chin and John coming on board to take over the CIO and CEO roles. I think it's very important. Just we're getting bigger. I mean, you don't want to have Greg juggling too many different roles, so he's really kind of handing off, I would say, a lot of what he would do to the CEO and CIO. I think then it's just kind of more big picture planning from Greg going forward, and I would say we're likely at one point have another fund, but I'm not gonna what that is. It'd be tough to say, but there would be opportunities in this, real estate space here in Canada. So it'll be interesting to see what we can do, but never, worry that the REIT would ever kind of lose focus. It's keeping it simple, very simple, with a little sleeve of lending, a little sleeve of, obviously student housing, but just multi-residential in Canada is what it does extremely well. So
another thing worth mentioning to investors is, as Matt suggested, going on to Centurion's website themselves. Greg loves to write, and you should look at some of his white papers. I presume they're left up there, Matt, they can read his thoughts. He's very articulate in this space and in finance world, and you can learn a lot as a reference point there.
absolutely, and I'll say they're very interesting reads, and Greg doesn't pull any punches. He'll let you know what he's thinking. So very interesting. Yeah, yeah. Great suggestion, Robert. Absolutely.
Yeah, that's good. And then just sort of curious from a lending world, I guess the lending portion of the portfolio, which is unique to you guys, I guess it's sort of pared back in recent years, given that there's not a lot of builders that are building out there, or developers rather. I imagine that's scaling back a little bit.
Well, definitely kind of COVID really pulled back, obviously. And since then, it's been, as you can see, around like 4 to 5% of the portfolio. So it's still, and we're lending to developers. I'll say we know they're good developers putting up products we like in areas we like. So it just makes a lot of sense. But yeah, we're keeping it really tight on good developers, on obviously multi-residential rental buildings. Um, but it's been a nice way to get more product into the portfolio. So which is nice to see. So maybe that gets a little bit bigger, but I mean, just the size of the REIT, maybe it gets to 6 or 7% a bit. But it's always a great, nice to lend at in double digits. So nice little way to get extra income.
So what's the new target? What's the AUM, if that's the benchmark? I presume, is there any sort of lofty goals that Greg and the new management team wanted to achieve, or have yet, maybe perhaps they have yet to communicate? I know you mentioned they just came in March, but anything you can tell our investors here? Any tidbits?
I mean, right now we're 7.8 billion. I would say the next big number is obviously 10. But I mean, this is a fund that can, give it, looking out, it can get to, 15 or 20. Give it, 10, 15 years. It can easily be of that size. But I always just stress, but we do that growth properly. So we do it prudently, protecting investors while we do it. So, but it's exciting. It's going to be, I mean, Canada's going to see good growth. That I'm not not worried about, and I think Centurion will do things properly to be part of that for sure.
Fantastic. Well, those are all the questions I had, Matt, and great to see you again, and great to come out and communicate these things to the investors and watch all this on their own time and hit record or rewind.
For sure. Well, a pleasure. Yeah, great to see you again, Robert. So
Yeah. Well,
we'll,
thank you.
no, very welcome. And yeah, I'll leave it. Things look good. The future looks great for the REIT. So
Fantastic. Look forward. Look forward. You guys always do what you say.
absolutely. Thank you.
Thank you.